Hello and welcome to our 2023 Q4 quarterly market review. I'm Ryan Dunn. I'm a wealth advisor with Novi Wealth, and I'm joined by Mario Nardone, our chief investment consultant. Today, we want to wrap up 2023 and discuss some of the changes, both positive and negative, that we saw throughout the year, as well as some things to keep in mind as 2024 gets started. So Mario is going to take it from here.
Sure. Well, thanks, Ryan.
Mhm.
Nice to be here again, and good to be in front of you and your audience. And I look forward to running through some of our slides, talk about the markets as you suggest, and in particular, put it in perspective about how our portfolios may have responded to the environment.
Perfect.
All right. All right, there we go. All right. Well, like you said, here we are. We're ready to discuss the fourth quarter. We're already a little bit into the new quarter and new year, but we're going to just take it as if it were a snapshot at the end of last year. And as we normally do, we like to take a measured approach, maybe a balanced approach, we might say, because there's always some good things happening and some things to be a little bit concerned about. And we don't want to be too optimistic or pessimistic. So some of the reasons that we might be optimistic are on the left side of your page, pointing out that it actually was a very good year for investors. 2022 was a challenge. 2023 wasn't too bad. It was also a strong year for the US economy. Inflation continues to come down, and employment is still strong. We're going to talk about this term soft landing a little bit later on in the presentation, and the fact that it may actually be possible. And from an investment standpoint, there's actually more income to be earned from fixed income. Another way to say that is that bonds are back. Now, on the right side of the page, we have some reasons for potential pessimism. Going back to stock market returns, we'll talk about on slides today that the US stock market strong returns were really just driven by a handful of big stocks. And that's not typically what we want to see in order to assess the health of a stock market rally. We cannot ignore the geopolitical risks. Now we have two major wars that we're following in the Ukraine and in the Middle East. And we have a presidential election cycle starting to heat up. And that's always fodder for uncertainty and just question marks about the market. But it really shouldn't be. And we have a slide to address that. And then inflation, even though it's coming down, it's not dead yet. There's still a chance it could kick back up, especially the component that's due to energy costs and the price of oil and how Middle East tensions can affect that.
Yeah, I
Now,
think
this is a pretty...
Oh, sorry, Mayor. I think 2023 was certainly an interesting year where on January 1st of 2023, I doubt very many people would have thought we'd end up where we did at the end of the year. I mean, in the beginning of 2023, we were still dealing with high yet cooling inflation. The war abroad was still at the forefront of everyone's mind, and the stock market was still struggling at that point. And you look at the end of the year, and really, it seems like things had turned around at that point.
Yeah, that's a great point. We're going to address the turning tide, if you will, over the course of the year and address that actually probably I think on the next slide. But before we get there, this is a busy slide. So if you're watching the recording, you can feel free to pause and read all the text. But I'm going to call attention to the third and fourth bullet point. And that really just paints the picture of what the global stock market returns were for 2023. 22%, that's the return for stocks around the world. 26% was the S&P 500 return. Those are very strong numbers, especially when you consider the average annual return is more in the neighborhood of maybe 8 to 10%. Then the second to last bullet point, kind of like what you just mentioned, 3.1% was the last reading that we got on inflation, having fallen since seeing a high rate of about 9% in the middle of 2022. So I'll let you read the other numbers on your own, but we're going to address some of that through the course of this conversation. But back to your point, Ryan, if you recall, every first quarter, we like to look at how well the prognosticators called it in the previous year. So these are some of the major financial institutions that we looked at. These are actually the ones that we looked at in the beginning of 2023. So no one can accuse us of cherry picking. And as you can see here, every one of these major financial institutions underestimated the result that we saw from the S&P 500 last year, between a range of 8% underestimation to 22% underestimation. And like you said, the order of the day, or the mood of the day, is what results in these predictions. So we weren't in such an optimistic mood on January 1 of last year, and that baked itself into these estimates or predictions. Now, it's important to point out is that we don't incorporate predictions into our investment strategies. We just like to point this kind of information out to illustrate why, because it's just so difficult. Here's another slide that addresses that very same fact, and it goes beyond just last year, and it goes beyond just those handful of institutions. This was a study, or a series of studies, that was done to evaluate a number of forecasters' estimates over the last 6 calendar years. So what we're looking at here are the predictions in blue, and then the actual results of the S&P 500 in orange. Now, as you can see, in some cases, they overestimated, in some cases, they underestimated. But regardless, each year, and this is the median of the forecasters' outlooks, in each case, they were wrong. The median estimate was wrong by double digits. So again, it shows that no matter how you're feeling at a given moment, or the temptation to want to invest according to your outlook, it's just really a fool's errand, and we suggest ignoring those tendencies or those predilections.
Yeah, I was reviewing the slides before this, and I saw the colors of this slide, and I think whoever created it might be a Miami Dolphins fan.
I hadn't thought about that.
Based on the burnt orange and the aqua. But yeah,
well, maybe we'll see if they have a prediction for the Dolphins next season.
Yeah. But yeah, it's just another example of the fact that the experts don't really have a crystal ball, like you said. And clients, I'm sure, have heard us say that many times. And I love seeing so many examples of it, because it just solidifies the point.
Yeah, there's very few examples to the contrary, in fact.
Right.
So now let's turn our attention a little bit from the market to the economy. And I know a lot of people kind of put them together, but they are different things that affect us in different ways. As we've discussed for the last few quarters, a lot actually, is that the Federal Reserve has been trying to bring down inflation. That's the main reason for them to raise their short-term borrowing rates. Now, if you look at the blue line, that's the evidence that inflation has come down. We could say the Fed has succeeded. Yes, they've contributed, but there are other factors at play too. But okay, the Fed has raised rates, inflation has come down. But what's really interesting about this exact period in time is shown by the green line, and that is the unemployment rate. Basically, throughout this period of Fed tightening, as they call it, unemployment has basically been unchanged. And typically, when inflation comes down, it comes down with something they call a hard landing, meaning there's some pain in the economy. And the pain is usually in the form of higher unemployment. So the folks who actually put this chart together actually suggest that what we're seeing is nothing short of a miracle on the part of Jerome Powell and the Fed, that they've been able to pull inflation down without causing problems in the labor market. Now, it's still yet to be seen if it's going to fully shake out this way or not, because the Fed still wants to get inflation down closer to 2% versus around 3% where it is. So I'm not sure I'd be calling for a miracle just yet. To put the Fed's activity into a really easy visualization, we show here the path of the Fed funds rate, that short-term borrowing rate that the Fed controls. So in 2022, you see an aggressive series of rate hikes or rate increases. Then in 2023, the increases started to become lesser in magnitude and farther in between. And most people believe that there won't be any more increases, but it's still yet to be seen whether we'd start to see decreases anytime soon. We're now into 2024. Most of the Wall Street odds makers are saying that there will be a decrease in rates sometime this calendar year, but the Fed is saying they're still going to be quote unquote data dependent on deciding where to take rates next.
Yeah, and speaking of forecasters being wrong, I think one agency that had a great track record in 2023 was the Federal Reserve. I feel I didn't go back and look at the data, but I feel like they had telegraphed the rate hikes ahead of time pretty well and only deviated from their initial hike projections once, if that. So like you said, we'll see 2024. I think they were initially thinking of doing 3 rate decreases throughout the year, but we'll see if that remains to be seen.
Yeah, that's a great point, Ryan. I mean, the Fed wasn't always so transparent. But starting with Alan Greenspan and then certainly with Bernanke, and since then, they recognized that giving forward guidance on their activities really did help the market have some footing rather than waiting until the meeting and finding out what was done. Because if there's one thing that investors and in particular corporations don't like, it's uncertainty. And if they don't know where rates are going to go, they're going to be more reluctant to hire or make capital investments. So that's a great point. And the fact is that the market tends to respond to guidance. And that's why we don't see huge action on the day of the Fed meeting, because it's already been baked into expectations. So great point. So one of the most direct influences, or one of the factors that's most directly influenced by interest rate movements is bond returns. We often hear the very quick, easy axiom that when bond yields go up, prices come down. And that was very evident in the fourth quarter and last calendar year. And basically what I want to, without going into too much gory detail, investors were generally rewarded last year for, first of all, owning bonds in general, because especially at the end of the year, bond yields actually did come down a little bit. So that's why we see positive returns. But in particular, investors were also rewarded for owning corporate bonds. And that's typical in an environment when stocks do well. It basically signals that investors have a higher appetite for risk. So riskier corporate bonds tend to do better than safer treasury bonds. And also municipal bonds have done extremely well recently. So investors in high tax brackets in taxable accounts have seen very good returns. And we're still seeing a very good outlook for municipal bond portfolios. Now, this page shows a lot of different information. Don't want it to seem too daunting or intimidating. But when you see the term yield curve, basically what a yield curve is the yield offered by a type of bond of various maturities. So if you look at the top left, here we're looking at US Treasuries. And if we focus on the dark blue line, basically what we're seeing is that shorter term Treasuries at the left have a current yield that's higher than longer term Treasuries as you move to the right. This is something that's known as an inverted yield curve. And the reason for that is because the Fed has raised short-term rates so much, but the economy, participants in the economy think that those rates are going to come down. They think we're probably going to hit a soft patch in the economy, so longer-term rates are lower. Now, I just want to focus on that all by itself and ignore everything else on the page this time, because one question we're getting a lot is that if we're getting a higher yield on cash or short-term bonds, then shouldn't we just own all cash and all short-term bonds and ignore longer-term bonds? And while we agree that holding cash is nice right now, it's nice to get a decent yield. If we moved out of those intermediate term and longer term securities and short-term rates do come down, and if they bring the rest of the yield curve down with it, we will have missed the opportunity to lock in higher yields on those longer term bonds. And that's a concept known as reinvestment risk. So we don't want to put all of our eggs in one basket and shoot for that higher short term return because we don't know what's going to happen down the road. And now let's turn our attention to what most people probably came to hear about, and that's the stock market. Here we have the US stock market sliced up by company size and investment style. So we have large and small company stocks, and then we have growth-oriented strategies and value-oriented strategies. And as you can see here, the scaling of the chart is really affected due to the high returns of those gray bars, which represent large cap growth stocks. And in particular, we're talking about large tech companies, and we'll get into some detail in a second. But in reality, don't let the scaling of the chart obscure the fact that returns have been good across the board, especially on the calendar year basis, which is the middle and right graph.
Yeah, and once again, I mean, this slide goes to show the importance of diversification. I think we're going to look at the Callan chart later on, but I mean, really, what we try and preach is we want to capture gains in all of these areas and not just make a bet in just one particular asset class. Yes, if we were all in large cap growth for 2023, that would have been a great year for us to do that. But if you look back at 2022, I think large cap growth was probably down a pretty significant amount. So we want to make sure that we're invested in all of these different sizes and styles, and get a good blend so that our clients are getting returns from all of those different areas.
Yeah, exactly. And even, to kind of further make the point, yes, we want to have exposure to all parts of the market. But we don't have a concentration in the largest, growthiest stocks in the market. And that's by design, right? You alluded to the point of diversification. And what you're seeing on the page is the 7 stocks that have recently been dubbed the Magnificent Seven. We've been renaming these top stocks for the last 3 years. I think we had FANG, and I forget what it evolved to after that. But at the end of the year, these stocks represented the largest 7 companies in the US stock market. And if you look at the return in the right column of each of those stocks, this is really where the S&P 500's return has come from. It's where almost all the outsized return has come from. And because we believe in diversification, because we have small cap, because we have value, because we have international, that by definition means we're going to have a lesser concentration in these 7 ultra huge technology stocks that happen to have a great year last year on the heels of lots of talk about artificial intelligence and things like that. So, even though we may have missed out on some of this return, quote unquote, missed out, we have had exposure to it. We just haven't had an overexposure to it. And I think by definition, that also means we have a better chance of avoiding the fallout if it turns out to be a bubble. And we'll talk a little bit more about valuation in a minute. So to put the Magnificent Seven in perspective, this shows you their total market capitalization on the left. So you see Apple's the largest company, Microsoft is the next largest. So as you stack those seven large companies up, you can see, compared to the graph on the right, that the market capitalization of just 7 stocks is now greater than all the stocks combined in Japan, the UK, and Canada, which are the second, third, and sixth largest stock markets in the world. And we're talking about just 7 companies. So the questions become around, how sustainable is that? How big can a company really get?
Yeah, it's crazy to me to see that Apple's market cap is, if I'm reading this right, is as large as the entire equity market of the UK.
Exactly.
The fact that one company can be the same size or larger than another first world country is kind of mind-boggling.
Sure. It is. Agreed. So that talks about their absolute size. But what really matters in investing is something called valuation, right? You might have heard the term price to earnings ratio or price to book. The valuation is really how much are you paying for a dollar of earnings of that company. So you're buying stake in that company, you're entitled to a portion of its return, for lack of a better word, right? So these high returns from these 7 big tech companies have driven up the price tag or the valuation of not just those companies, but of the US market as a whole. So thinking about the S&P 500 index or the total stock market index. So if you look at the bar on the left, you see the US valuation based on that light blue diamond there, currently at 19.5 times earnings, is currently pretty substantially higher than the US price to earnings ratio over the last 25 years. And that's reflected by the purple bar. Now compare those current valuations for the other bars on the page, which represent other parts of the world and their respective stock markets. And you could see that US valuations are much higher and that there are actually many more bargains to be had by investing in companies outside the United States. And now looking at the historic return or recent returns of international stocks, we could see that their performance over the last quarter and year on an overall basis were pretty similar to US stocks, with the exception of the outsized returns in US large growth. But what you can't see on this page is that the concentration of returns wasn't nearly the same as we saw with the Magnificent Seven. For instance, we already know what they did, but the top 10 non-US stocks return was about 18%. And that was about the same return for the remaining stocks outside the United States. So that's a much different experience than what happened here in the US. And again, I alluded to this in the very early parts of this presentation, but when you try to assess the health of a stock market rally, for lack of a better word, we want it to be more broad-based. We'd rather see investor enthusiasm across the board, not just concentrated in a particular sector or a particular type of company. So one of the tailwinds that has been driving non-US stocks and may continue to drive it, depending on the direction we go from here, has been the declining value of the US dollar. And that's shown by the bottom graph here. And just for a quick education, if you take all else equal, a weakening dollar makes non-dollar denominated assets more expensive in dollar terms. I'll say that again. If you own a non-US dollar denominated asset and the dollar weakens in value, that means that when you translate that asset back into dollars, you can buy more dollars back. So that's actually a benefit to us as we own non-dollar denominated assets. And we often say that, owning these ex-US companies that are non-dollar denominated actually provides a sort of hedge against our dollar-based consumption. So for instance, if the dollar declines, then the things that we want to buy from overseas or the components that end up in our products end up being more expensive. So if we own stocks that are denominated in those foreign currencies, that actually hedges some of that problem away.
Yeah, I remember back in 2022, the fears of COVID were starting to dissipate at that point, and we were encouraging clients to start traveling abroad again if they wanted, especially to Europe, because the exchange rate of USD to euros at that time, I think it was almost a 1-to-1 parity. Yeah, I think you can see that here actually. So yeah, I mean, it looks like at this point though, like you said, the dollar's strength has started to cool off a little bit since then. And clients are structured in a way that would benefit them.
Let's see, I mentioned I would have one slide to appeal to folks that are already closely monitoring the election news. And we're going to make it relevant to both economics and investing. So what you want to focus on here, and this is a very busy chart, but basically the color-coded line graph represents the percent of Republicans in red and Democrats in blue who had positive views of the economy during each of the last 4 presidential administrations. So if you go from left to right, you start with the Bush era, then Obama, then Trump, and then Biden. And as you can see, sentiment seems to be influenced by who's in office. When Bush and Trump were in office, Republicans tend Biden were in office, you see the blue line coming out on top. And so the first thing to do is make sure that we are not letting our political views give us a sense of, what's going on in the economy, because we all do have tendencies to think in those terms. But if you really want to see whether it matters from an investment perspective, just look at the inset. And they don't really call attention to these date ranges based on the president, but they do color code them the same way. And you can see that there really is no rhyme or reason to think that the stock market will perform one way or another based on the politics of the day. And most importantly, if there are folks that are taking it to an extreme and saying, I want to pull my money out of the market because of whoever's in office, you just have to look at that page and say, look, maybe I lean Republican and I didn't want to invest during Obama's administration. I would have missed out on 16.3% annualized returns. Same for Trump, 16.0% annualized returns. So we want to make sure we take politics out of our investment thesis and make sure that we stay the course and invest according to our goals and risk tolerance and not let the noise influence those decisions.
Yeah, I mean, there's been multiple different studies done by various different institutions that go back, 50 plus years and compare the market returns to the presidents of whether they're Republican or Democrat. And they all come back to the same conclusion, like you just said. There's no data that shows that one party is better at providing good stock market returns versus the other. So I think your point is very warranted.
And I know the slides you're talking about, and I think we've probably presented them before, but you're right. This is just the most recent presidential cycles, but you're right. No matter how far back you take it, the data still holds. So with that, Ryan, I'm going to kick it back to you to close it out. We always end on this slide, which reminds advisors and clients, investors, I should say, that we know about everything we just talked about. We follow the economy, we follow the market so that we could put sound strategies in place. But really what we try to do is focus on the things that matter and the things that you can control. And those are listed on the page here. So again, I'll kick it back to you. If you had any additional questions or comments, feel free to ask away, but I'll let you close us out.
Yeah, thank you, Mario. That was great. And yeah, I mean, in regards to this slide, it's something that we preach to clients. Clients probably hear this from us all the time. Is just controlling what you can control. And that's really where we want to put our focus and have our clients attempt to put their focus, is understanding that we can't control what's happening in the stock market. We can't control what's happening halfway across the world. So don't stress about that. Don't let your emotions or feelings about certain things have you make any rash decisions with your investments. And I think, Mario, you touched on quite a few different things where during this presentation that go to that point. So yeah, I think that everything was great. Thank you again, Mario. And looking forward to a good 2024.
Likewise, Ryan, and thanks again for having me on this call.